Okay, so we can immediately move on to procurement strategies and open positions. So here's how, if we have retail customers, we manage our open positions in a municipality, in a utility. We start again with an introduction, then we present an example, and then we discuss chances and risks. So again, we are discussing the case where we have portfolio management which buys in the wholesale market and delivers on the retail market. This is found, for example, in municipalities, in retail energy companies, and also in very large consumers. Again, we said it has minor differences, but the question again is, how do I buy on the wholesale market what my company consumes, my chemical factory or something? Okay, the question is, how can we make profits, if we go back to the retailers, from retail activities? In its purest form, the utility buys energy on the wholesale market and sells it to retail customers on the retail market. The profits for the utility must thus come from selling the energy at higher prices than buying. And this profit can be increased by three things. A, having an excellent sales team on the retail market, selling at high prices, knowing the customer, developing a brand, sponsoring local events whatsoever to enable your sales team to sell at high prices. Essentially there you have to be better from the perspective of the potential retail client than your competition. The retail client could buy from you, but she could also buy from Vattenfall, from whomever is out there in the market. And you want to make sure that they buy from you, and if you have an excellent sales team, then they buy from you, even though you may not have the cheapest price compared to the competition. So that's one thing. Of course, the higher your sales price, the better it is. But of course, the retail clients will compare your offer to other offers. So you have to have a good offer. Okay, the second way of increasing revenues is to keep costs down within the utility, lowering the overhead per unit sold. If you have very efficient processes, if you're very, very small in the organization, you don't have that many mouths to feed or wages to pay, then you can live and still earn profits from a relatively small difference between selling price and buying price. Or you have less costs you have to include on the buying side. Okay, that's one. So number one, to repeat, having an excellent sales team, selling at high prices. Number two, keeping costs down. And number three, having an excellent procurement team on the wholesale market, buying the energy at low prices. So that's the alternative. Unfortunately, the wholesale market price is what the wholesale market price is. There is no negotiation there. If you see the price, as we saw on a screen, on a broker screen, there is no negotiation. You take it or leave it. You can't say, well, but no, nobody's interested in that. The price is the price. But still you can do some things, and we will discuss that. Essentially, you can manage an open position to earn money. The open position for retail-focused utilities is thus important. The open position denotes here, for the retail-focused utility, the difference between purchase, buy, minus retail sales or consumption, con for a delivery period H. For example, 1 hour of a year in the future. So here the open position OPH is defined as by H minus con H depending on pH. So the consumption may depend on the price. This is both true for a municipality and also true for Deutsche Bahn and their portfolio management team exclusively procuring electricity for Deutsche Bahn. Maybe certain processes in the consumption side can be shifted between hours. Of course, we want the trains to drive, but maybe they have some other chances. Maybe they even have some storage facilities or something along these lines, which they can shift a little bit. So consumption may be somewhat decreasing or at least reacting to the price. Okay, so that's how we define our open position. We sell or consume and we buy wholesale, and the difference between these two is our open position. Again, the open position for period H, delivery period, can change over time, trading period. Note again that the open position can be positive. The utility bought more for H than it sold, or negative, it sold more than it bought. On the day before delivery at 2:30 p.m., all balancing groups must be balanced. Again, that means open positions must be 0 for all 24 hours of the following day. So here, again, we have this balancing group issue helping the TSOs to guarantee and maintain stable grid and stable frequency. Here, we as a municipality, as a utility, have a physical word. In contrast to the prop trader, who was not really interested in the physics behind it and had to make sure that on the day before delivery everything was sold, which was bought before, so open position was 0. Here the open position also has to be 0, but in a way differently because we have physical consumption and delivery behind it. Our consumption or delivery to the retail customers has to be physical. They want the energy physically. So what we buy and put into the balancing group has to also include physical production or provision, for example, from forwards. Okay, so in the case of a utility, this implies that the utility bought exactly as much as it expects to deliver in aggregate to consumers in each hour of the following day. In the case of a large energy-intensive consumer with its own portfolio management, this implies that the consumer bought exactly as much as it expects to consume himself. So that's the definition of the open position. And again, such a portfolio management process for a typical, let's say, somewhat larger municipality goes few years in advance. So we are managing procurement for the front year and for the upcoming year after that. Usually the year ahead and 2 years ahead and maybe even 3 years ahead are in the focus of the procurement process of the portfolio management. And we do observe and steer an open position for that. There is different possible procurement strategies depending on the goals and the risk specifications. In fact, there is a wide range of different strategies for purchasing energy. From a trading point of view, these differ in particular with regard to the risk. We can have very low risk strategies, you see this in the box on the left, or we can have high risk strategies, which you see in the box on the right. Low risk implies you have no or hardly any open position. This is also called back-to-back procurement. So essentially, whenever your sales team sells electricity to an industrial consumer, for example, today your sales team locks in a sale to an aluminium smelter for next year, your sales team reports to the procurement team, to the portfolio management, and the portfolio management for low risk immediately balances the deal by buying on the wholesale market. So that's why it's called back-to-back. As soon as it's sold, you buy it. No, hardly any open position. However, while this does not involve any price risks, it does not involve any chances either. So the margins in that case must come, at least primarily, from sales and low overhead costs. So we just said there is 3 ways of making money here or increasing profits. Selling at high prices from sales, having very, very cost-efficient processes, or buying smart. And if we don't want any risks, as I said, on the wholesale market, the price is the price. All we can do is buy later and have an open position, or buy early and have an open position. And if we take that away, then in order to increase profits, just the other 2 remain. And thus margins must come primarily from sales, selling high, and low overhead costs. On the other hand, if we argue that the procurement also should contribute to revenues, we take on risks. No chance without a risk. Then we take the choice of favorable procurement times, identifying low prices. So we have the objective of buying low. This may be before the customer even wants the electricity, or this may be by leaving, if we expect falling price trend, leaving an open position, a negative open position, after our sales team sold to the customer. Then we say, well, we could buy it today, but we believe tomorrow it's going to be cheaper, so let's wait till tomorrow. And if tomorrow is cheaper, we can either buy and lock in a profit, or we can say, well, falling trend, let's wait and see what happens. A month from now, it's going to be even cheaper now, even cheaper yet. You wait a month, and if it's even cheaper, then you buy then. And then you have profit. You sold something here, prices declined, you buy here. You make a profit. However, this requires risk management and risk capital, because as I just said, even the choice of favorable procurement times already implies taking risks. And then there is, as you see in the second bullet, speculative portfolios with a variety of strategies. When I was doing this, working with a customer once who was systematically selling options to financial players. There was a municipality and they sold options, which is very, very risky. I would even be inclined to call it dangerous. But as long as, in a way, let's say you had the right market assessment, you can, of course, earn significant revenues from the premia. If you sell an option, you receive a premia for it, and if the option in the end is not exercised, you can keep the full premia, the full option premia. But that, of course, requires even more sophisticated risk management and risk capital. But here, the idea is that the margins should also be realized through procurement below sales prices. So all 3, selling high, efficient processes, and procuring smart, should contribute to the revenue of the company. Let's move on to an example for this. Simulation of a portfolio management process. So how can this look like? The aim here is to explain the basics of the procedure using an empirical example. We simulate 2 alternative procurement strategies over time. Numbers are based on price curves for a historic delivery year, but it's more about the general principle than making relevant which specific year it is. We use automatic purchase triggers to simplify the simulation and to clarify the functionality and the possibilities. This is an important caveat to say up front. So what we are aiming for here is to set up a procurement strategy where the individual decision to buy is directly derived from the price we observe. In reality, there could be, say, a human factor or some market developments. We could do fundamental market analysis in order to define when the right time is to buy. However, that is hard to explain in retrospect. When I was a portfolio manager, honestly, I hated it when in retrospect, when you look back on 2 years of price history, I mean, honestly, not even a very smart person can identify in retrospect when it would have been the best day to buy. But when you did not know the future coming there from the past, you did not know how the next 2 years would look like. You just observed some development until day T, and then you just had to decide, do we buy on day T, without knowing whether it goes up from there or further down. And in retrospect, when you see the full development, assume now, like as I said, everybody can identify the minimum. And we had some really annoying talks where people in retrospect told, why didn't we buy everything there? That was the minimum price. And you're sitting there like, because we didn't know at the time. But that's like kind of ex ante decisions, which we do without having full information, are totally different from what's ex post correct. So a decision which is optimal ex ante, based on what we knew at the time, may well, taking into account the uncertainty involved, be not optimal ex post when we see how the uncertainty manifested. I mean, very simply speaking, imagine you take a 6-sided dice, and you're supposed to say whether the number is odd or even. Without throwing the dice, you do know, well, it's 50-50, not much to do about it, but in the end you have to decide, so you choose either one. Then you throw the die, that was the ex ante decision you had to make. Then you throw the dice and the uncertainty manifests, and then ex post, it's pretty easy. So throwing the dice first and then asking, so what should we do? Should we go for even or uneven? Pretty easy, but also pretty stupid, because that's kind of besides the point. Everybody can do it. The market has the fundamental property of uncertainty. The uncertainty is inherent, but the uncertainty also has some things you can identify. Markets are mostly correct, but not always correct. So you may be able to beat the market by making smart decisions. But that, of course, does not guarantee that you beat. You may improve the odds in your favor. So you may, for example, know that this particular dice will throw an even number, not with a probability of 50%, but with a probability of 75%. So of course you predict an even number and you even put money on it, but you may still end up with an odd number. Okay, so but all this discussion is very hard to do, in particular in a video, in an online course. So while most real strategies have a certain component of this, here in this example, we abstract this away. We take a pretty simple procurement strategy, which can be performed and benchmarked purely on the price realization. How we do that, you see in the following. Okay, so let's assume, and that's the starting point for such a portfolio management or procurement process, we know the company's risk attitude. Whether they want more a back-to-back strategy or whether they are willing to take certain risks, assuming that on average they can earn a profit. That chances in a way outweigh the risks. We have to know that in order to find the optimal strategy. And then, as I said, we have a rigid procurement mechanism here, which has the advantage of avoiding irrational short-term decisions. So yes, you should in practice work with limits. That's very important. But it's also very well suited, as I said, as an ex post empirical example, and at the same time not truly 100% covering what goes on in practical applications. Okay, here we assume the price triggered purchase orders are triggered by a dynamic stop loss. A dynamic stop loss, think about what this may imply. It's actually pretty straightforward. Stop loss means you have a certain expectation, in particular if you wait to buy, you assume prices go down. You hope prices go down. But the stop loss says, but if what I hope for does not manifest, I want to stop my losses. So if prices rise instead of falling, I stop and take the loss. And here you just have to specify how much rise you are willing to accept. And we say 40 cents per megawatt hour. So if given on any settlement price we saw in the past, the price rises more than 40 cents, we buy. That's one point. And dynamic means we adjust this limit whenever we see a lower price. So dynamic stop loss limit of 40 cents means, if we have an example, we start on the first day of 50 euros per megawatt hour. That's the settlement course yesterday, and we start the portfolio management today. Assume the first observed settlement price tonight is going to be 49 euros. Then we say, nicely done. We have earned €1. We made the right decision not buying at 50 because now we can buy at 49. We hope the price goes further down, and we did not reach our limit, which on the first day at 50 was set at 50.4 euro cents per megawatt hour. So if instead of falling to 49, the price would have increased, as soon as the mark of 40.4 would have been reached, we would have triggered the procurement. We would have bought. Maybe not really truly at 50.4, maybe at 50.5 or something, because we then discuss and then we have to go to the market, we have to buy, we have to find proper offer for that, and so on and so on and so on. So it's not truly guaranteed that the limit is exactly reached. That's not the idea. It's just that you avoid waiting, hoping, praying maybe, but things get worse and worse. So at 50.40, as soon as you see this, you trigger procurement. Okay, but let's assume we did not have to do that. Limit was 50.4. We did not see that, it was not reached. Instead, we went down to 49. Now, the dynamic point, we now adjust the limit. We shifted from 50.4 to 49.4. 49 last settlement, lowest settlement observed so far, limit at 49.4. Now assume next day we have a small increase to 49.2. What do? We do not adjust the limit. Limit stays at 49.4, was not reached, so procurement goes on. Now assume we go down to 48. We say, nicely done, great job. Now we have €2 earned. New reference price, dynamic is 48. New limit, 48.4. So whenever in the future we reach 48.4, we're going to buy. And now assume that happens. Just to keep the example short at this point, we reach this and we buy at 48.45. And then we did a pretty good job because it's 3% earned. Instead of 50, we bought for 48.5, which is at least 3% savings, which can be a significant sum of money. Okay, so that's the fixed link to a reference price with the previous defined gap, spread in this example 40 cents. The reference price is upward stable. That's why I said if the price increases to 49.2 from 49, limit is still 49.4. And downward dynamic. Downward we adjust to each newly reached minimum. The dynamic stop loss can be used to procure standard products and schedules. But note that real-world portfolio management strategies are more complex. I already said this. Permanent evaluation of activities and, if necessary, iterative improvement process of the procurement system should also be performed. Okay, let's move even more into an empirical example. Take the example of a household customer portfolio with an expected sales in year Y of 534 gigawatt hours and a maximal demand of 141 megawatt. Maximal demand. The background for the utility you are working in: the utility is risk averse but open to an integrated strategic approach. Start of portfolio management was October 1st, 2 years before delivery, so Y-2. End of portfolio management should be September 30th, year before delivery due to long-term planning. So 3 months before the first delivery day on January the 1st, we want to end the procurement, to have a stable price and so on. Additionally, we could implement a strategy where we close at least 85% of the open quantities in order to get a calculation basis for the expected price level. Okay, first and relatively simple example for a structured procurement process. We procure 4 identical slices or schedules. So we say, look, we have the total amount, 534 gigawatt hours, 141 maximal demand. We have an underlying profile, we know this, and we take 4 identical slices out of this profile, which in sum exactly aggregate to the profile of 534 gigawatt hours. And we say we buy one of these schedules in each quarter to get a solid, distributed, risk-averse procurement price. So we don't buy everything in 1 hour, it may be the wrong time, but instead we buy 4 different slices, 4 schedules in 4 different quarters, which gives us a more average price. Purchase trigger, as we said, is a dynamic stop loss related to the base product with a spread of 0.4 euros per megawatt hour. The reference price corresponds to the European Energy Exchange's closing price on the first day of each quarter. So we know, here you see in the table at the bottom, that in the 4th quarter, 2 years before delivery, we want between the 1st of October and the 21st of December to buy one of these schedules with a total energy amount of 133.5 gigawatt hours and a maximal Pmax of 34.25 megawatts. Okay, then in the following 1st quarter of the year before delivery, we want to buy the 2nd schedule. In the 2nd quarter, we want to buy the 3rd schedule. 3rd quarter, we want to buy the 4th schedule. And as we said, we want to be done after the end of the 3rd quarter in order to have the last 4th quarter to prepare delivery, to plan delivery, things like that. And of course, the total, all 4 schedules exactly have the maximal demand of 141 megawatts and the total energy desired of 534 gigawatt hours. Please think this over watching this video. Turn on pause for a moment and try to recapitulate in your own words, what does the procurement strategy look like? Redescribe what's going on. Second question, why does the limit not remain permanently unchanged? For example, 40 euro cents above the opening price. Third question, do you believe in the success of such a strategy? If you were asked, assume you're a portfolio manager in a company and a client, for example, asks you, how should we do it? You're a consultant, or you are entering the portfolio management team of a large industrial consumer, and they employed you to reorganize the process. They have worked together with an external company, but now they want to do it in-house, and they ask you, how should we do it? Do you believe in the success of this strategy? What, in your words, are the advantages and disadvantages? What would you do differently, spontaneously? And then please consider, does the strategy work in rising markets? Does the strategy work in falling markets? Does the strategy work without any market expectation? So when the price fluctuates stochastically. Here's a brief outlook on the tutorial. If you're doing the full course with us here at BTU, then you will also take part in the tutorials, and there we analyze the performance of this strategy with price simulations. We do Monte Carlo simulations on the issue, in a sense. So we model multiple price paths with stochastic processes, and then we analyze the influence of different market trends. Rising, falling, no trend. This last question can, of course, be answered with Monte Carlo simulations. Then we compare the performance to a benchmark, and we analyze other influence factors, such as volatility of the market price. What happens if volatility is small, in particular compared to the 0.4? What happens if volatility is high? What happens if we vary spread levels instead of 0.4, just 0.2? And the like. And here you see a few beautiful pictures from former tutorials on the subject. Okay, that's the strategy. Now let's see what happened historically in one example. So here we said we enter first procurement in the fourth quarter, 2 years before delivery. You see here, the opening price was 33.85. Our first limit was thus 40 cents higher at 34.25. And then during the first years of the days of the quarter, the prices fell. Again, that's good news for us in terms of procurement, because then buying at the first day would have been wrong. What we do to wait is correct. And then we see here a minimum price reached at 32.95 before our limit was reached and breached. So at 32.95, our new dynamic stop loss went down to 33.35. And then after this day, roughly the 14th of October, prices started to climb again. And then roughly on the 28th, our procurement limit, dynamic stop loss limit, was reached and we bought. However, we said this is the base price depicted here, which is used as an easy reference price. As I said, this standard product is quoted often, very transparent. You always get price information, and we use that to identify the right point in time to buy. But we don't buy the base because we said it's a schedule. It's 1/4 of our aggregated consumer profile. And then we, on that day, procure this schedule by, and that's how a lot of trading of schedules happens, sending out an Excel sheet with the schedules. There is nowadays more elegant ways instead of exchanging Excel sheets, but that still is done sometimes. So essentially you say, look, this is what we want, 8,760 hours, and that's how many megawatts we want per hour. Can you give us an offer? And here is the first procurement happened at the 29th of October, 2 years before delivery, with a base price of 33.51 and a peak price of 42.13, and the scheduled price will be reported later. And then you see, just without you doing anything, because you have bought your schedule which was due in that term, in that quarter, here, by the end of October, November and December, all you do is wait. And actually sometimes you benchmark the success of your procurement to the average price. So what you hope for is, after you bought, high prices, because that brings up the average of that quarter and made your decision good. But here essentially it looks pretty good. Again, what I said a few minutes ago, in retrospect, it's quite easy. We should have bought on the 14th of October at 32.95, or we should have waited until the end of the quarter where the price was even slightly lower. But again, of course, point is we didn't know at the point we had to make the decision. Okay, now we do this 4 times in total. The next 3 quarters we repeat it. Second quarter, same story, opening 32.88, limit at 33.28, prices fell. We have the lowest price before procurement of 31.36. Limit was thus dynamically adjusted to 31.76. Limit was reached and breached roughly on the 14th of January, the year before delivery. And we purchased at a base price of 32.14, peak price of 40.81, the second slice of our total volume. Again, same amount. What was it? 133.5 gigawatt hours. Pmax, so maximum demand, 35.25 megawatts. Okay, third quarter we procure is the second quarter of the year before delivery. So we do the third procurement in quarter 2, year Y-1. You know the drill by now, please figure it out and go walk yourself through it. Here, again, look at the picture, and even in retrospect, would you say it was a good procurement? I would say it was good procurement. Last but not least, the remaining amount, fourth procurement, happening in quarter 3, year Y-1. And we do this in July. And then we've procured everything. And here we have a summary table of what happened. First procurement, 29th of October. Second procurement, 14th of January. Third procurement, 3rd of June. Fourth and last procurement, 14th of July. You see the base price, the peak price, and the scheduled price, which is somewhere in between. And then you have the average price in euros per megawatt hour. And just for reference, I would like to show the total price in euro. This again is something I find truly impressive about this portfolio management. That's why, or one of the reasons, as I said, it can be a lot of fun, but also why I worked there. It's huge amounts of euros involved. This is an average sized municipality, and the procurement here just for the households was more than 18 million euros just for a single year. And if you are just as said. So at some point, we were able to save 3% in an example. Please calculate how much 3% of these 18 million is, and then you will find out that it's pretty easy, even from those 3% savings, to finance, for example, a portfolio manager, to finance 1 or 2 people doing the analysis. 3% of the volume, euro volumes involved here is significant money. That's why it's so important, and that's why so much manpower is going into it. Okay, this is a visualization of the process, the 4 procurements. You see that 3 of them look pretty solid. The first 3, while the 4th we were stopped too early. In the last quarter, it would have been better to wait longer. Okay, that was a first example to structure procurement. Here is a second example to structure procurement. Same amount we need. Again, the 534 gigawatt hours. Again, the same maximal amount. But here we take a slightly more realistic and slightly more approach to structuring in the beginning. Here we say we want to trade the standard products, not these schedules we have to send out by Excel. We do have to do that as well for the structure. But here we want to buy as much as possible with base and peak standard products. So we say out of our 534 gigawatt hours, we want to buy 20 megawatts base load. Where 16 megawatts we procure quarterly using a limit system, while the remaining 4 megawatts we buy during the delivery time at the spot market. That is also possible, of course. As I said, you can buy in the spot market. And then we procure 28 megawatts of peak, 24 megawatts quarterly using a trading approach, 4 megawatts during the delivery time at the spot market. So 4 megawatt base, 4 megawatt peak go into the spot market. And then there is the remaining structure after you deduct base and peak. That's here in this example, roughly half of the 534 gigawatt hours are now, of course, in very, very, very peaky schedules. So there is 270.62 gigawatt hours remaining load profile, which is split into 2 equal remaining schedules, each with 135.31 gigawatt hours. The first schedule is procured at historically low prices. We will define how that is triggered automatically. And the second is procured in the third quarter in order to adapt to changes in the customer structure. So the idea is, with a certain amount of structure, to wait until we know, for example, how many household customers have changed their supplier. So that's why we want this second schedule relatively late. Okay, here is how this structuring works. We have already had an earlier slide on this, but here again we have base shares, which we can then buy on the OTC market or on the exchange. We have peak shares we can buy as forwards or futures. And then we have some spot market energy, and we tender on the market for the schedules, for the 2 schedules. And then in the end there is some remaining 15-minute load profiles, which can be bought differently. So we do a structuring of the forecasted demand into tradable standard products and the remaining load profile. Yeah, this is visualization, beautiful visualization of what we are procuring. 5 times 4 megawatts base, 4 times 6 megawatts peak plus 4 megawatts peak in the spot, and the 2 remaining load schedules. In German they're called Restfahrpläne, remaining load schedules, of 135 gigawatt hours each. So that's what we want to buy. And this is how we do it. We buy 60 megawatts quarterly using the same already established limit system. And that can be seen here. That's essentially what we already have seen for the schedule, because in the first example and the first strategy, we used the base price dynamic stop loss limit to determine when we buy the schedules. Here we use the base price dynamic stop loss limit to buy 4 megawatts base load in each quarter. So you see here exactly the same moments when these procurements are triggered, but here it's purely the base price which is relevant. Okay, then we have the peak. The trading approach here is buy when the daily chart breaks through the 6-week moving average from bottom to top. But other triggers that appear reasonable are also possible. This is just to show you the variety of strategies people are implying or applying in practice, trying to beat the market. So we look at the daily chart breaking through the 6-week moving average from bottom to top. The underlying reasoning is that the market moves in trends, and if the daily price increase is significant and it goes through certain threshold values, for example, moving averages, that indicates a lasting increasing trend, and then we should buy. You may believe this or not. You can, of course, come up with other strategies, other triggers that appear reasonable or also possible, but this is one which is used by some people in practice, at least in similar forms. Doing that, we see here when we buy. So one procurement we do at the 7th of November. The blue dashed line is the moving average, the black line is the daily price, and at the price which is highlighted here, the green dot, the daily price goes through the moving average in an upward direction. And if you look at this here, it was even a reasonable decision because we had a lasting increasing trend afterwards. Second procurement, 4th of February. Third procurement, 22nd of June. Of course, I'm not really re-explaining this, but again, here you see in June, the daily price cut through the moving average from bottom to top, and there was the procurement signal. And the last, 4th procurement, there the price was consistently below the moving average, so we just bought at the end of the quarter. So that's showing you, explaining a different strategy for the peak. And then we have the two remaining load profiles in the two schedules of each 135 gigawatt hours. First remaining schedule procured at historically low prices. Second, third quarter. What means historically low? Here we define this as follows. If the current price is below the moving half-year average and when the moving 6-week average begins to rise and breaks through the moving half-year average from below. So here you see all these averages. Please reread this carefully. Probably you should hit pause for a moment and look what's depicted here, and then you can figure out when procurement happens. And this is when procurement happens. Both schedules are procured in the third quarter. First, the 28th of July. Second, 28th of August. Okay, and now we have the final result for this Procurement Strategy 2. a little bit more complex because we had the base products, we had the peak products, and we had the scheduled price, and we even have the spot market procurement. And here you see that in total, of course, we bought our 534 gigawatt hours. And you also see in total we paid roughly 18 million again, 17.885 million. And the average total price was 33.49 euros per megawatt hour. Comparing all four of them, if we take the average price as the benchmark, then the average price was 33.97. Strategy 1 would have been even slightly more expensive than the average. That is not good news, because in that case, we could have bought the average, which is possible. It's an offered product by many trading houses, because you can always physically replicate the average by buying a very small piece of the total volume each day. If you have, say, 534 gigawatt hours, which you want to purchase over 200 trading days, then on each trading day you buy 534 divided by 200. So roughly 2 point something gigawatt hours per day. And that can be done. So you can essentially buy for the average without paying for the portfolio manager. So being more expensive than this average is bad news. However, luckily, or actually positively for our portfolio manager, Strategy 2 was successful. We were 50 cents cheaper. That's even more than 3% in this. No, that's 1.8% or something in this example. We were roughly 50 cents cheaper than the average with Strategy 2. Okay, and as I said, these strategies are somewhat automatic due to us showing them based on historical prices and replicating them in Excel and doing them in the tutorial and doing simulations on how it progresses. In reality, like I with a PhD in energy system analysis, are more inclined to analyze the markets fundamentally. I, for example, would also take into account what energy systems models tells us on where the frontier contract should be. Of course, the model is always a simplification of reality, but if there is a strong deviation, something is going on in the market. If my model persistently tells me frontier base should be at 30 and the market trades it at 50, I may be inclined to say this is an exaggeration. I cannot fundamentally explain this. So it's a bubble, and then I can decide whether I believe this bubble will burst before delivery, so the spot will indeed be cheaper, and then I would, based on that, derive trading decisions. But as I said, there is a variety of trading strategies, and other people with different backgrounds may prefer different strategies. In the end, you have to be successful. You have to make money for your company. Then you're a good portfolio manager. Okay, let's review the learning objective. What is the aim of both procurement strategies? I just said that in the last sentence. How do the procurement strategies differ? Please go back, repeat both of them. What are the differences? How would you, as the person responsible, proceed when purchasing this portfolio? Both regarding the strategic orientation, do you find it reasonable to expect the procurement team to contribute to these three revenue sources? Selling at high prices through good sales contacts, keeping processes small and costs down, and procuring below market price or below current market price, actually? Or would you say, no, we cannot beat the market? That would be interesting, so please think about this. That's the strategic orientation. And then in the tactical decisions, on what basis would you make the specific trading decisions? once you've thought about this, we have a few more things for you to think about. One is, what problems do you see with this procurement strategy? How should one proceed to ensure a holistic view? And I'm helping you with that. This goes back to what I said very, very early in the example. I started the example saying here we procure 534 gigawatt hours of households consumers. And before that, I said, well, for household consumers, it's a little bit difficult because we don't really know how much energy they're going to consume, because they may change their supplier, and we may not have them in our portfolio, or we even may have additional household customers we don't know about yet. So the point here in this problem I would like to make you aware of is, what is the open position for a household customer? For an industrial customer, it's quite simple. You at some point sign a contract with them which specifies the volume, and from that point on, they are included on the sell side of your open position. But for the household, it's much more difficult.